On Business Incorporated today. Zimbabwe to prop up currency with special drawing rights from the IMF. Mauritius hold rates until economy revives. Kenya and Tanzania set December deadline to remove trade barriers. Hello and welcome to the program. I'm Ini John McCoy. Well, let's start as usual with intraday market, starting with the African continent. We see investors showed mixed sentiments at intraday on the African continent, but there were more positive sentiment. Nigeria's NGX was trading in the green, up 0.03%. GSC of South Africa was the only negative. It lost 0.3%. EGX 30 of Egypt was, however, doing really great. It was up over 1%. Kenya closed positive at the end of Tuesday's session. It was up 0.18%. Over in the Middle East, negative sentiments permeated the day. Major markets were trading in the negative territory at intraday. Abu Dhabi lost 0.21%, while Dubai lost marginally 0.05%. Elsewhere in the region, Saudi Arabia lost 0.06%, while Qatar shed 0.28%. We move to Europe now, where markets were muted today, tracking global sentiment as investors await a key meeting of central bankers. The pan-Europe stock 600 inched 0.15% higher in early trade, while travel and leisure stocks added 1.4% to lead gains, while utilities slid 0.5%. The Germany flood is still in the news, and we have Chelsea joining us from Frankfurt to give us the details. Hello, Chelsea. Good afternoon.
Glad to be here.
Glad to have you. So a survey shows that German business sentiment worsened in August for the second month. What's driving this?
And this survey is one of the main reasons why we've seen such a poor performance in the DAX today. As you can see behind me, it's really underperforming the other indexes in Europe. And this survey from the IFO Institute here in Germany did show that sentiment among businesses has worsened basically for all industries, particularly in the manufacturing sector, which has been really struggling this year with different supply chain problems, raw material shortages. Companies had been working through stockpiles that they had of materials that they had, but they are running out, and many companies now just don't have the materials to continue producing at the same level. So we've seen, for example, in the auto industry, companies like Volkswagen have to shutter production lines because they just don't have enough materials to keep those manufacturing lines running. But it's not just the manufacturing sector; the services sector as well is also going a lot more pessimistic about the future of the economy, and that's largely because many are concerned that we will see new restrictions put in place because of this fourth wave of infections that is looming over Germany and Europe right now.
And still talking about German businesses, there are talks of another lockdown. How serious is this talk of another lockdown?
Well, it's clearly something that businesses are growing very worried about. For now, politicians here in Germany are trying to play down the potential that we will have to see another lockdown or stricter restrictions put in place. We heard today from the economy minister, Peter Altmaier, and he says because of the vaccination level here in Germany, which is now at about 60% of the population having both of the vaccines, we shouldn't have to see businesses, close in the same way that we did a year ago. But what we have seen is more and more businesses restricting access for people who are unvaccinated. That's become a major point of controversy, but also a major strategy for Germany and other European countries. But businesses are still really concerned about this. We've heard from several industry associations, such as the hospitality industry, as well as the trade industry, over the past couple of days, and they're really urging politicians to not revert to lockdowns once again, because it would be catastrophic for their industries, they say.
All right, and the floods are still in the news, the floods from July, and insurance companies are saying it will cost more than expected billions of euros. What more do we know about this?
So this is from an estimate released today from the German Insurance Association. They say that so far they've received damage claims totaling about 7 billion euros from residential property owners, from businesses, as well as for damaged vehicles. And that's much more than they had initially estimated when these floods hit Germany last month. It really destroyed several towns, particularly in Western Germany. But they had initially thought it would only cost maybe about 5 billion euros. 7 billion euros is clearly a big increase as well. This is only a small portion of the overall cost of this flood. Only about 50% of homeowners in Germany have this type of insurance, so many people will be uninsured. We seem to be having a bit of a party behind me now, but a lot of people won't be getting money from insurers. The federal government as well has put forward billions of euros to help rebuild these cities. The Deutsche Bahn as well is having to pay about 1 billion euros to rebuild their rail network. So there's really a lot of expenses, and it will likely rank as one of the most expensive natural disasters in German history.
Sadly so, and we can see it's an exciting day at the boss there in Frankfurt today. Well, thank you so much, Chelsea, for bringing us up to date from Frankfurt. Enjoy the rest of your day. Well, let's move over now to the UK, where we have Juliana standing by. Hello, Juliana. Good afternoon.
Good afternoon, Innie.
Yeah, so Morrisons and Meggitt looks set for a brief return to the FTSE 100 index of blue chip UK companies. How are investors reacting to this news?
Yeah, this is a really good story, particularly for investors. Both Meggitt, the defence company, and Morrisons, one of the big 4 supermarkets here in the UK, have been in the midst of a bidding war. I suppose it's the Morrisons one that's grabbed most of the media's attention. $9.5 billion bidding war started by Clayton, Dubilier and Rice, which are a private equity firm. Fortress also want to get their hands on the supermarket. So an independent global index indicator has advised the FTSE 100 board that they're both eligible to be upgraded and uplifted because of their share price. Morrisons, for example, since CB&R announced a potential takeover, their share price has increased by 60%. So that's really good news. Not great news for other companies. JustEatTakeaway.com, a really big story that they may be getting the boot from the FTSE 100, not because of their share price. However, it has been pretty bad over the past couple of months. It's fallen about 20%, but it's because now it's deemed as being a Dutch company, therefore ineligible to be a part of the blue chip index. I suppose we'll be discussing more of that later on in the week. And also ITV, massive broadcaster here in the UK, pretty well known for Love Island. I don't know if you've heard of Love Island, probably a rival to Nigeria's Big Brother, but alas, it's market capitalization not good enough for the blue chip index. However, this is just an indicator. I think a final decision will be made on the 1st of September, I believe.
Okay, and how is the FTSE and other markets indices reacting to this?
Yeah, doing pretty well at intraday. It started off in positive territory. It's extended those gains at lunchtime. The FTSE All Share currently up by 0.26%. The FTSE 100 also up by 0.20%. And the domestic market, the FTSE 250, doing very well today, currently trading higher by 0.55%. In the currencies market, the British pound down on the US dollar by 0.01%, up though on the euro by 0.06%, and also up on the Japanese yen by 0.10%.
And there are indications that the London junior stock market may be getting an addition. Real-world health and artificial intelligence-based firms seems to be indicating that they might be going there. What else do we know about this?
Yeah, this is a big story, all speculation so far, but they are an artificial intelligence firm that basically helps hospitals have an indication of just how many patients are coming in and out of their practices, and they're able to devise programs and plans to help their practice run even better. So you can imagine just how well they've done during COVID-19. They already provide services for some of the largest pharmaceutical firms here in the UK. And now, according to media reports here in the UK, they are planning a £100 million flotation on AIM, which is kind of a minor, well, still huge, but the most minor index here in the UK. If it is going to take place, it will be taking place in the first quarter of next year. But yeah, another good British business story, especially because the owner, I believe, is of African descent.
Makes us happy. Well, thank you so much, Julian, and enjoy the rest of your day.
Thanks, Ine.
So let's move to Asia now, where stocks were mixed at close today as optimism continued to drive U.S. stocks, with the S&P 500 and Nasdaq reaching record highs overnight. Meanwhile, India's benchmark index hit a record high. Hong Kong's Hang Seng index slipped 0.13% to close at 25,693.95 after jumping earlier. Chinese tech stocks listed in Hong Kong paired this morning's gain, losing steam by close after rallying Tuesday. The Shanghai Composite jumped 0.74% to over 3,500, and the Shenzhen Component rose 0.23% to close at 14,697.50. Over in South Korea now, Kospi rose 0.27% to 3,146.81. In Australia, the S&P AX 200 was up 0.39% to close at 7,531.90. Iron ore prices soared, giving mining stocks a boost. They shot up almost 9% yesterday, and commodities analysts say that we should expect more. Moving to the U.S. now. Stocks were higher today following a broad-based rally on the news that U.S. regulators granted full approval for Pfizer-BioNTech's COVID vaccine. The Dow Jones Industrial Average rose 30.55 points, which is less than 0.1%, to 35,366.26. The S&P 500 added 0.1%, closing at a new high, 4,486.23. The Nasdaq Composite gained 0.5% to 15,019.80. This is also a new high. Shares of vaccine makers pulled back yesterday. Pfizer and BioNTech were more than 3% lower. Moderna fell 4.1%, and Trillion Therapeutics, which surged about 180% in the prior session on news that it would be acquired by Pfizer, closed 0.6 lower. Travel stocks extended their rally from Monday, with several airline and cruise stocks rising. Casino operators, Las Vegas Sands and Wynn Resorts were also higher by about 7%. Travel restrictions after much travel restrictions were eased, with improvement of COVID-19 case outlook in China's province, a key visitor source for the gambling capital. Let's go to the oil market. Now, prices fell today, taking a breather after a strong rally this week, spurred by the loss of a quarter of Mexico's production and signs that China, the world's biggest importer, has curbed a recent coronavirus outbreak. U.S. West Texas Intermediate crude futures fell 25 cents to $67.29 a barrel, while Brent crude futures dropped 22 cents to $70.85 a barrel. Both benchmark contracts rose about 8% over previous 2 days, erasing most of the slump from a 7-day losing streak. Prices mainly climbed because of the loss of more than 400,000 barrels per day of supply in Mexico after a fire on an oil platform. Last week's losses were driven by fears that the spread of the highly contagious Delta variant of COVID in Asia would slow the region's economic recovery. Demand in the United States, which is the world's biggest oil consumer, appears to be holding up well, and that's according to latest data from industry group American Petroleum Institute. In the metals market now, gold prices fell today as dollar ticked higher, with investors awaiting Federal Reserve Chair Jerome Powell's speech this week for possible guidance on the tapering of the pandemic-era stimulus. Spot gold fell 0.4% to $1,796.03 per ounce, while U.S. gold features 0.6 to $1,797.50. The dollar index inched 0.1% higher, denting gold's appeal for those holding other currencies. SPDR Gold Trust, which is the world's largest gold bank exchange traded fund, said that its holdings fell 0.2% to 1,004.63 tons on Tuesday. Silver eased 0.4% to $23.03 per ounce, while platinum fell 0.5%. Palladium was down 0.6% to $2,459.89. We'll take a break now. When we come back, we'll bring you stories from the African continent. Do stay with us. It's Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated on Channels Television. Now, COVID-19 has caused major disruptions to shipping around the world, made worse by a recent outbreak of COVID among dock workers at the world's third busiest container port, Ningbo, and that's in China, which has reduced the port's capacity by a fifth. Well, we'll talk more about this and the impact that it has on Africa, West Africa. We'll talk about this with Ted George, Chief Narrative Officer at Clears Advisory UK, joining us. Hello, Ted. Good afternoon.
Hi. Good to be back.
Great to have you. So can you please paint a picture of how COVID has impacted the world of shipping?
Well, it's had an enormous impact. And the real problem is that so many of the value chains nowadays are just in time. The idea is you get the goods or you get the inputs at a time where you can get them out just in time to reach certain peaks in seasons. It's much more efficient and it saves money. But none of them were prepared for what happened when COVID hit. And the reality is too many of the world's containers are simply in the wrong place. There aren't enough of them in China. We also saw a lot of disruption in the Suez Canal as well. And of course, that's caused massive backlogs.
All right, and we do know that this, of course, will bring up some costs. How are the, the stakeholders, how are they running this cost? Are they just passing it to consumers? How are they managing the cost, the extra costs that come with this?
Well, it's astronomical, the increase in cost. If you look at a typical container from Shanghai to Rotterdam, now costs 14,000. That's 7 times what it was. 10 times as much from China to the west coast of the USA. And even Shanghai to West Africa is at the highest rate it's been for 20 years. So it's going to go through into the cost of goods, particularly things like sportswear, footwear. A lot of them come from Vietnam nowadays, and that was disrupted by COVID. And of course, there's a global shortage as well of conductors, semiconductors for electronics like smartphones, PlayStations, TVs. So I think what this means as we enter supposedly the shipping season ahead of Christmas, a lot of goods around the world are going to be slower to deliver and probably more costly, and quite possibly the models you want not available.
So is the situation better now? I mean, the U.S. has just given full approval for Pfizer, and a lot of countries are focusing a whole lot on vaccinating their citizens. Here in Nigeria, a lot of government officials or government arms are kind of, pushing it down that people need to get vaccinated. So is the situation better now?
Well, but it depends where you are in the world. I mean, the thing is, there's a real imbalance here in terms of vaccinations. Here in the UK, where I am, over 90% of the population have either been double vaccinated or already have the COVID antigens. So the fact is, we're still trying to see how the Delta variant plays out. But I think there is a switch now that a lot of people are recognizing. Those who were against vaccination for whatever their reasons are, who are starting to realize they need to get it. But the real trouble is it really comes down to public information, education, cultural as well. The real question, I think, in Africa is how can we get a lot more vaccines to Africa, because there are millions of people who definitely want it right away, even before we consider those who might be against it for whatever personal reasons.
So, what does this cost the continent, Africa, now? When we talk about the economy, we know that countries like Nigeria depend a whole lot on import. How is it this disruption? How much has it cost the continent?
Well, it's costing a huge amount, particularly when it comes to trade, because the thing is that the level of the volume of drop in trade has only been relatively light in West Africa, particularly Nigeria, only about 3% down, compared with more than 14% in regions like Southern Africa or East Africa. And that's because Nigeria continues to increase its imports from China, Europe, and USA, over $50 billion estimated last year. But export volumes have fallen and values as well. And so it's got this really unsustainable, huge import deficit. It's got to consider how it's going to finance going forward. That has a real impact on everyone. It has an impact on prices and on the economy. And ultimately, Nigeria still has something like 15 container ships waiting to go into it because there's not the capacity there. So it's suffering the same kind of problems that the rest of the world's shipping routes are. They are strained at the moment. And that is going to mean reduction in certain goods, but also pushing up prices, which affects everyone.
Yeah, so that means the continent has to be ready for this Christmas and wonder how it will be. Well, thank you so much, Ted, for sharing your thoughts with us and exposing some of these things to us. So enjoy the rest of your day.
Thank you.
So let's move on to Zimbabwe now, where the country will use more than half of the $961 million it has been allocated by the International Monetary Fund in the form of special drawing rights to support its currency. The government abandoned a 1.1 peg reintroduced Zimbabwe dollar and the greenback February of 2019. The currency now trades at 85.82 to the US dollar and even lower on the black market. The plunge has made it difficult for the government to get it accepted locally and it's generally not tradable outside the country. The Southern African nation abandoned the Zimbabwe dollar in 2009 after inflation rose to 500 billion% and legalized trade in a range of currencies, including the US dollar and South African rand. Now, Mauritius Central Bank will keep its benchmark interest rate at a record low of 1.85% until the economy shows signs of a sustained recovery. Meanwhile, the central bank expects the tourist independent Indian Ocean island to expand 5.5% in 2021. That's down from a February estimate of 7.9% after a second wave of coronavirus infection forced the country to impose new lockdown restrictions. Mauritius' economy shrank 14.9% last year, the biggest contraction in 4 decades. The Bank of Mauritius Monetary Policy Committee is scheduled to hold its next meeting on the 6th of October. And a joint team of Kenyan and Tanzanian officials have set December this year as time by which most of the non-tariff barriers affecting trade would have been resolved. The decision came following a meeting of the Joint Commission on Cooperation, a bilateral organ created to resolve issues affecting all areas of cooperation between the two countries. The 5-day meeting in Nairobi, which ended yesterday, indicated that the two sides have agreed to remove barriers that have consistently affected trade, signaling more efficiency of their cross-border businesses. Let's go to South Africa now, where the Financial Sector Conduct Authority has suspended the exchange license of stock exchange ZARX over liquidity and capital concerns. ZARX, which is the country's first alternative exchange, had concluded a significant equity transaction with a foreign-based investor to acquire a controlling interest in the exchange. But it says this transaction has stalled the inability of the Public Investment Corporation to grant formal approval of the transaction. Meanwhile, the PIC insists that it has continued to support ZARX turnaround strategy, but has had to do so on a risk-adjusted basis for the benefits of clients on whose behalf it invests. Well, we have a correspondent who spoke with an economist on this issue.
The PIC will step in because the suspension of ZARX as an alternative stock exchange has been in terms of their capital adequacy ratio as well as liquidity. We have to take this into account. ZARX, being an alternative stock exchange, they suffer liquidity and they don't have quality of issuers, meaning companies that are listing on ZARX. And those companies that are listed there themselves are actually not covered by research analysts. So when you don't have analysts that are covering that stock, it means that institutional investors are precluded from being able to invest in those companies. And South Africa, unfortunately, does not have the depth of retail investors who would ordinarily have been participating in a ZARX platform.
Well, still in South Africa now, the Special Risks Insurance Association expects claims related to the unrest in July to amount to 20 billion rand. The association notes that rebuilding of damaged infrastructure for larger companies is going to take a long time and asks for patience from its clients as they continue processing claims. The insurance company says over 95% of insurance claims are being attended to, and there have been concerted efforts to settle all small claims, with 10% of the 20 billion rand expected to be paid out by the end of the week. Well, that's it on the program today. Thank you so much for watching. I'm Ini John Mekwa.